Hello and welcome. It's a historic day as Bloomberg Quint launches India's first digital live streaming business news service. You are watching Ask BQ on Bloomberg Quint and I am Pradeep Pandya.
Hi everyone, and I'm Navneet Saluja D'Souza. Well, this is the show where we address your stock queries. We are live on our website, Facebook, Twitter, YouTube. You can also see the show on Bloomberg Terminal. So keep your questions coming. You can write to us on Twitter, Facebook, or just pick up your phone. Call us on 022-4540-4141 with all your stock queries, and we will try and address as many queries as possible today on the show. Just remember to add the Ask BQ hashtag. So let's get in our two experts of the day. Joining us on the show is Jay Thakkar, who is an Assistant Vice President at Equity Research, at Anand Rathi. And also joining us on the show is Parthiv Shah, who is a Director at Tracom Stock Brokers. Both these guests will help us to answer the queries.
Before that, let's have a look at markets. Markets are actually trading weak if you look at Sensex and Nifty and also sectoral indices. Most of the sectoral indices are actually in red. Well, global markets are trading a bit soft today. If you look at Asia or even the way Europe is about to open, currency market is also under pressure. So rupee has fallen along with other Asian currencies. In fact, rupee has hit a 10-week low today, and that is where the pressure point probably is building from because of the Fed decision. Actually, most of the currencies are trading lower compared to dollar, and that's the impact we see on equity as well. If you look at sectors and stocks, pharma stocks are doing well today. Dr. Reddy is, of course, in lead after another upgrade. And also, if you look at losers, banks, financial services, NBFCs, well, that's the pack which is actually looking weak right now, Navneet.
Well, clearly, it's turning out to be a weak day of trade. It is also the Bank Nifty options expiry day, so some sort of profit booking has kicked in today's session. But let's get straight to the queries first. And our first caller of the day is Rahul Shah, who's calling us from Mumbai. Hi, Rahul. Thanks very much for calling us. Tell us what's your query on.
Good morning, Navneet. I have some funds close to 5 lakh rupees that I want to allocate to the pharma sector. So I was just wondering, Sun Pharma, Lupin, Ajanta Pharma, which stocks would you guys recommend so that I can invest my money in pharma sector?
Okay, Rahul, before I get the query answered from our expert, just want to check any specific reason that you want to invest only in the pharma sector?
I see good value in pharma sector right now because from major of the stocks have fallen almost 50% from 52-week highs or all-time highs. So that's the reason I'm planning to allocate some funds over there.
All right, point taken. Pharma counters have seen a lot of correction in the last 12 months. Let's go across to Parthiv to find out what should Rahul do. Hi, Parthiv. Rahul wants to invest 5 lakh into pharma counters. Would you suggest him first to invest in pharma companies? If yes, which are the stocks that you would recommend?
Hi. Assuming that Rahul is already having a diversified portfolio and some part of his capital is wanting to allocate into the pharma sector, the reason being he's absolutely right, and I agree to his view that it's become a contra sector right now because the valuations are abysmally low if you see the historic trend. And I think it's the best time to invest in good quality companies and good sectors which are futuristic, especially when they have any short-term hiccups. And I believe that yes, there are great companies like Sun Pharma, Lupin, which he just mentioned, which are available at really reasonable valuations. And I think let's understand the pharma from a longer perspective. And I assume that, he is someone who wants to invest in this sector. So one can take a call for at least next 3 to 5 years. All these companies have a fantastic specialty pipeline because we know for the fact that the generic pipeline currently is having a lot of price erosion. In US, a lot of distributors have merged, so that is why they are having a better bargaining power. And that is the reason we are seeing that from a high base, all these companies are not able to report very good set of numbers, especially in terms of the revenues and also the margin erosion that we are seeing. But we are quite confident that these are companies who are not stopped spending on their R&D. And I think they're continuously trying a lot to build on their specialty pipeline. Likes of Sun Pharma and Lupin have also done some inorganic moves to justify that. And I think based on the management commentary, come FY19, many of these drugs would tend to get onto the market, and we'll see that they'll command a better margin because of less competition. And also we'll see from FY20 the run rate of growth, which was around 20% of compounded annual growth rate in terms of the revenue growth and the margin growth and the EBITDA growth, that will again come back. So I think that is why these companies are available at rock bottom valuations. So I like both these counters, Lupin, Sun Pharma. I would just suggest that instead of Ajanta Pharma, a better pick would be Cadila Healthcare. The only reason being, this is one pharma company which has been very resilient. It has all its plants cleared, especially the Moraiya plant, which is very important. And they have a fantastic pipeline of very good, high quality ANDAs. So I think I see a very great future for Cadila Healthcare as well.
Okay, so Lupin, Sun Pharma and Cadila Healthcare, these are the three stocks that Parthiv recommends for you, Rahul. So you could buy these three, maybe in equal quantity, so you could distribute your 5 lakhs among these three stocks. And let's move on now to the next query. And now this is a query on Twitter, I believe. Vinayak Satish Kumar, he has written us on Twitter. He has 50 shares of Force Motors and he has bought at 3,990 and he can hold for 6 to 7 months. He wants an advice on this stock going forward. 6 to 7 months. Well, that's not really a long time. Jay Thakkar is also joining in now. Jay, what do you recommend?
Hi, good afternoon, Pradeep.
Afternoon.
Well, overall, Force Motors, we have seen this stock, in fact, trending quite higher, and it's in past has been a very good uptrend. I think in the future as well, we may see this stock trending higher only because recently what we have seen is this stock basically consolidating within a range of, on the upside, I would say 4,650 to on the lower side, somewhere around 4,000. So that's been almost like 600 to 650 points range for this stock. But the way the stock has been heading higher and forming high tops and high bottom on the weekly charts, I believe that till 4,000 levels on the lower side are not broken. The probability of this stock, in fact, providing a breakout above 4650 is quite high, and thereafter it will range towards the levels of around say 5,200. That's the equality target on the upside of this range, above 4600. The indicators on the weekly and the monthly charts are supporting the bulls as of now. So I would say one can continue to hold this stock with a stop loss below 4,000 on a closing basis, targeting around say 50 to 100 going forward.
All right, that's the view coming in on Force Motor. Vinayak, we hope you're watching our show because Jay has just recommended you should hold on to your position on Force Motor. Though you've bought the stock absolutely at the high end of the price, it's at 3,990 and he bought at the same price, but you can expect higher levels from here on, so you can hold on to your position. Let's go across to our next query for the day, and we'll get you more queries which are just coming about. Manish Agarwal has written to us. He wants to invest in Hero MotoCorp and wants to know the prospects of the company with a short-term and a long-term view. Parthiv, a call on Hero MotoCorp. Do you think one should venture out here?
Yes, I absolutely agree. I think it's a great stock to buy in the two-wheeler space. Let's understand, knowing the fact that this is a company which has almost 50% of its sales coming from the rural market. And I think in the last few years, despite knowing the fact that the rural markets had some kind of stress due to the past droughts and other reasons, I think now is the time that rural story is going to definitely kickstart and pick up. And Hero MotoCorp has lined up many good launches, especially to target even the rural segment. And I think with the rural segment doing well, we are seeing a lot of NBFCs also lending to the two-wheeler segment, which is high ROE for them. I think all these two-wheeler companies are going to do extremely well, and Hero MotoCorp I think is extremely strong in the domestic market. I think I'm slightly skeptical for some of the export-oriented two-wheeler stocks because I think we know what cross-currency mismatch can do. But I think Hero MotoCorp has done extremely well in keeping its cost low. The margin profile is looking extremely good. They're delivering on the volume numbers, and I think they're commanding a very respectable market share. So I would attribute Hero MotoCorp to be like Maruti of the two-wheeler segment. And I believe at least if someone has a 3 to 5 year horizon, this company will do extremely well for investors. Okay,
so Hero MotoCorp is a good stock really to hold on to. Divyu Hira Nandini writes to us, and he has bought Inox Wind at 144 rupees and Satin Credit Care at 321 rupees. So these are the two stocks that he's holding on to, and he has a short-term view on both. Jay, what would be your recommendation?
Sure, Pradeep. First I come to Satin Credit Care. Well, this stock has recently provided a very good breakout from a downtrend and resistance in the short term, and the rise which we have seen right from the bottoms of or the lows of 256 until the recent highs of 345 has been an impulsive move up. That is a five-wave rising structure. Hence, I believe that we can see a good medium-term reversal in this stock. The stock has also provided a very good breakout from a double bottom pattern with a buy crossover in its indicators on the weekly charts. Monthly is also quite likely to provide a buy crossover. Hence, I believe that on the lower side, this stock has a very good support at 284.85 zone until these levels are not broken. As far as the medium term trend is concerned, the probability of this stock in fact achieving its equality target on the upside and moving towards 390 to 400 levels going forward, I think is quite high. So if someone has bought this stock, I would say that one can continue to hold on till 283 levels are not broken on a closing basis and targeting around 390 400 on the upside. Now, Pradeep, coming to Inox Wind, now this stock has been clearly in a downtrend, and we haven't seen any reversal as that of recently I discussed about Satin Creditcare, wherein we have seen a meaningful reversal. Inox has still not seen that kind of a reversal. The indicators too are in the sell mode, and the stock is clearly falling in a downward sloping channel, forming lower tops and lower bottoms. So I would suggest that one should exit from this stock and get into some better trending stocks, which could definitely help to gain some good profits in the short term.
All right, that's the view coming in on Inox Wind, but let's move on. We're getting more queries. Nishant Kumar Jain writes to us. He has 1,400 shares of EIL, which I believe is Engineers India, which he bought at a price of 87 rupees. He has a long-term view. In fact, he's a long-term investor. He wants to know whether he should hold or currently book out because he is making money here. Parthiv, what would you recommend one should book out if they're making any profits in Engineers India or wait for higher levels?
First, I'd like to congratulate the viewer because I think the entry point has been fantastic, and I think this is a great company to hold. Being a public sector enterprise, we are knowing the fact that lots of oil marketing companies now are in capex mode, and they are talking about capex of upwards of around 1 lakh crore over the next 5 years. And we know we have 3 OMC giants. There is also a lot of traction happening in the private sector hydrocarbon space, and EIL is having a fantastic expertise in project management consulting and also in some turnkey projects. They are also having some export orders at Nigeria which come at slightly higher margin, and we know for the fact that the balance sheet strength of this company is fantastic, and I think this government is really looking for such companies to create value for them so that eventually they can sell the stake at a higher premium. So that is another incentive that I believe that many of such quality run PSU stocks can bring. So I think the going is good. There is a lot of visibility in terms of the revenue growth, scaling up of margins, and the execution track record of this company in the past has been fantastic. Even in the fertilizer sector, which is another vertical they cater to, there seems to be some traction going in terms of companies looking to expand their capacity. So that is also another driver of growth for this company. So overall, I think Engineers India Limited is a fantastic stock to play a stock on an old economy where it seems like the private capex also going ahead in time, which will kickstart, will be beneficial to such companies. So I think it's a 3-5 year story. We are very confident on this stock.
So it's a 3 to 5 year story. You can hold on to this stock, a very good investment indeed for you. And let's move on. Next query is coming on Twitter once again. And let's look at them. Rahul Patil is writing to us. He has got 2,000 shares of Kane India, which has now turned into Vedanta at 305 rupees. He has bought this share. That is what he says. But was it the Kane he bought at 305, or is it the Vedanta price that he actually got? I don't know. But what's your call on Vedanta really? He can hold on to a year, Parthiv. That means we need a fundamental call on this stock.
Yes, we know for the fact that this was a stock which was available at 60-70 levels at a point in time when we knew that the commodity cycle was not doing well. The commodity prices were at abysmal low, and also the data from the Chinese markets were not at all supportive. But now things have changed, I think, especially in terms of the data points that are coming out of China, and the best part being that China looking to cut down on unwanted capacities, and even the Indian government trying to help many of the domestic ferrous and non-ferrous players. I think that bodes extremely well for companies like Vedanta, who have world-class assets. They have low-cost producing assets, which is always an advantage during distressed times. And now they can really have good operating levers in a good time like this. So I think they are looking to cut down on debts. They are even looking to buy some assets. And I think it's always a great idea to invest in a commodity stock which has well-diversified profile in terms of commodities like zinc, lead, copper, aluminum, oil. So I think it makes very good sense and it's a natural hedge. So I believe one can hang on to this stock, and I think 1 year is a decent time frame to make a judgment in terms of when to exit.
All right, that's the view coming in on Vedanta, but we're getting a lot of queries on Facebook. Let's just address them as well. The first one comes from Chandra Prakash Chaube, who's written to us. He has VIP Industries shares at a price of 197. Chandra wants to know what he should do. Should he hold on or sell? Mr. Tucker, I would like to come to you to get a view on VIP. How is it looking on the charts? Do you think he should book out? Because the stock currently trades at 252 and he's bought at 197, so very much in the money.
Absolutely. In fact, I would like to say that this is one stock which we recently had recommended to our clients as well, and I believe that one can continue to hold on this stock because this stock has provided a very good breakout from a flag pattern. And the target on the upside comes to around, say, 310 to 320. However, the recent rise, I would say, which we have seen from 171 levels till the current market price, has been an impulsive move. That is a 5-wave rising structure. So there does exist a probability that we can see some profit booking or a retracement of the same of the entire move from 171 to say to the levels of 270. And if it comes, then it can come to the levels of 226, 230 as well. So if he's a very short-term trader, then I think booking out the profits is a very reasonable thing to do at these levels. However, if he's likely to hold on to it for say 1 to 3 months going forward, then I think yes, one can continue to hold on to this stock. On the lower side, 230, 228, as I said, is a very good support with that as a stop loss on a closing basis, and in fact that would be a trading stop loss since he has bought it at 195. So with that as a trading stop loss, I think he can hold it till the levels of 310, 320 going forward for 1 to 3 months.
And let's move forward to some more queries coming in on Twitter. The next tweet has come from handle Learner9295. Well, so Learner wants to learn about ONGC. There's a stock he has bought at 180 rupees and he wants to know whether to hold or sell ONGC. Parthiv, what's your call?
I think I'm not really very bullish on ONGC for the longer horizon. The reason being, we know for the fact that the markets in the oil, I think especially Brent, look in the way it has behaved since so many years. I think this market will stay in an oversupply. We are seeing a world where there are lots of disruptions taking place. Automobiles are becoming a lot more efficient. The demand for oil is going down. Rather, there is a glut of many of the OPEC players not wanting to cut on their capacities. So I think ONGC being a direct proxy to the oil markets, and also knowing for the fact that of late the rupee has been very resilient, very strong, which is an inverse correlation to ONGC's realization. So that is also not a helping factor. And all these companies need to make really good realizations to have a huge amount of capex for future discoveries. So I believe that it's better to go into a stock like Vedanta, though being into the commodity space, which is well diversified, yet you get the flavor of oil, which is via the Kane India investment that they have. So I think I would any day prefer a stock like Vedanta over ONGC.
Okay, Navneet, in fact, it's interesting to note, recently we saw many reports coming about, base metal stocks. Analysts have upgraded them. The commodity desk at various FIIs have upgraded them. But if you look at crude, which is now quoting above $55 as on date, but there are no reports on crude really. Nobody's talking about $60, $65.
I think the last range I saw was 50 to 55, not beyond that.
Exactly. So people are still not bullish. Maybe this, upsurge is temporary in nature and it will again go back to maybe 45, 50 range. That's what most people are expecting. And that's the view Parthiv also shares.
Right. All right. So, Mr. Lerner, hope you're watching our show. Parthiv suggests to look at Vedanta instead of ONGC. But let's address more queries. Nayan Ganga writes to us on Twitter. He has 200 shares of South Indian Bank, which he bought at a price of 22 rupees. He wants to know whether he should hold or sell. Jay, he's very much in the money, and this is one counter which did pretty well in yesterday's trading session. Even on the future side, I've been tracking this counter. There are a lot of long build-up which are seen here. What would you recommend? Should the person hold with the investment, or one should just book profits?
Absolutely. In fact, in the last trading session, we have seen a good up move coming in this stock. Post its breakout from an inverse head and shoulders pattern, we have seen this stock in fact rising in a unidirectional way. On the upside, I would say the target which comes to my mind is 35-36, because this stock broadly had remained in the past in a broader range of say almost 32 to on the lower side say 15-16. Now with this kind of a breakout from an inverse head and shoulders pattern, is quite likely to again inch towards the upper end of the range, which has shifted higher, and that comes to around 35-36. On the lower side, now this stock has a very crucial support at 29. So I would say that if someone wants to hold on to his trade and would like to ride the trend on the upside, I would say with a trading stop loss of 29 on a closing basis, targeting 35-36 is still a good risk reward. So I would say one should do that. With a trading stop loss of 29, I would recommend to hold.
So Nayan, your stop loss is 29 rupees on a closing basis. With that stop loss, you could hold on to the stock and hope to reach up to 36. Let's look at the next caller, Shashank Tripathi. He writes to us. He wants to invest 1 lakh rupees in the market with a 1-year view and wants to know what stocks to look at to make the investment. He wants us to suggest one stock for 1 year time period with 1 lakh. Is that a good idea, Parthiv? One stock with 1 year time frame, or you would rather ask him to put maybe 25,000 each in 4 stocks?
You're absolutely right, Pradeep, because I think it's a very tough question to answer and just give a very high conviction one stock in a market where finding value is, I think, really rare, and just having a time horizon of 1 year. But I absolutely agree, if not 4, I think a good idea would be to at least diversify into 2 stocks, and 2 stocks, that too being of the large cap nature, because we know, especially in mid caps, what if a 1 quarter result miss happens, the stock could be down 20-30%, because right now nothing is cheap in the mid cap space. And I think in the large cap space, we still have stocks like Reliance Industries and ICICI Bank. Both of these stocks I would like to recommend the viewer. The reason being that I think Reliance Industries has definitely its earnings momentum going ahead in time, and I think this is a stock which is almost going to complete all its capex by FY18, and I think all the segments that it operates into, especially petrochemical and refinery segment, that's going to really be the earnings kickstart growth engine going ahead. And I still believe, I think it's not really that expensive despite the move, so I think it seems to be quite a resilient and a safe stock in such a market. So Reliance one can definitely buy for 1 year. The second stock is ICICI Bank. I think again this is a largest private sector bank which has hardly participated in the rally of the private sector banks, and I think if we compare in terms of the valuations with many of its peers, I think it's quoting at a huge discount, and this discount as of now is justified because of all the asset troubles that this bank is having. But looking at the way that government is also proactively acting in terms of trying to have resolutions, and also I think ICICI Bank has been successful in a couple of accounts in terms of the recovery, we are quite confident within the next 1 year we'll see a lot of better results in terms of operationally this bank has been giving good numbers, but in terms of the net and gross NPA levels and the slippages, I think if that averages, I think there's a lot of hidden value. We know all the subsidiaries that are listed, what valuations they command. So ICICI Bank can be a re-rating candidate, and I think for 1 year view, I think I'm finding it a lot more comfortable to park money in such ideas.
All right, Shashank. So with a 1 year horizon, you can look at putting your money in stocks like Reliance Industries and ICICI Bank. That's the suggestion coming from Parthiv. Let's move on. Sudeep Sarkar has written to us. He's bought 25 shares of Bombay Dyeing 1 year ago at a price of 197. He's also bought shares of Escorts at 181. He has a time horizon of 1 year, and he wants to know what are the future prospects of these companies. Jay, let me first congratulate Sudeep. He's made some amazing investment, Pradeep. Look at Bombay Dyeing. That counter has had a fantabulous year. It's up almost 350% on YTD basis. Jay, what would you...
But a year ago, in fact, the stock was quoting at around 50. So he must have bought that much lower price. Probably he's confusing with some other stock. But if he has really bought a year back, then he has already, tripled or quadrupled the capital.
Yep, and I guess even Escorts is doing well. Jay, what's the view on both the stocks and the charts? Do you think in the near term one can see higher levels, or there could be some room for consolidation here?
Well, absolutely. In fact, even I would like to congratulate. If he has bought at 60, 70 levels, as Pradeep just mentioned, then he's making 3 times the money invested. And I would say the kind of run up this stock has recently seen. In fact, as a disclaimer, I would like to say that we had recommended this to our clients at around 105 for a target of 145, which got quickly achieved in say 4 to 5 trading sessions. And we have been seeing this stock in fact inching higher and higher day on day. The kind of breakout which we have seen clearly classifies or qualifies, I would say, rather, for the wave 3 up move, which means that for the long term the stock has reversed from sideways consolidation or a downtrend to an uptrend. So if someone is a long term investor, say having an horizon of around say 2, 3, 4 years, then I would say the target comes to say in fact 680, 690 zones, so that's quite high from these levels as well. In fact, it's 3 times, I would say, approximately from these levels as well. If someone is really in this kind of a profit, then I would say risk reward or else trailing the stop loss shouldn't be a problem for a long term. However, for the short to medium term, yes, the stock definitely has reached to quite an overbought territory, and the indicators too have reached to quite an extent, I would say, rather the upper end of the range. So, booking partial profits would be advisable at these levels if someone is a short to medium term trader. The recent rise which we have seen, as Pradeep just said, from the lows of say around 60, 65 till the recent highs, has been quite an impulsive move. That is a 5-wave rising structure. So a retracement of the same, that is around say 38 to 50%, cannot be ruled out. And even if this stock corrects by say 38%, it may again fall back to 150 odd levels. So I would say the best strategy should be, if someone has bought really at 60, 70 rupees, then booking partial profits and re-enter at 150 definitely, because the long-term story, I think, has definitely reversed for this stock and it has way to go going forward.
Okay, that's the view coming in on Bombay Dyeing and Escorts. Well, Jay suggesting you could book partial profits here. On that note, Jay as well as Parthiv, thanks very much for joining us today on Bloomberg Quint and helping our viewers with regard to their queries. All right, we're completely timed out on this edition of Ask BQ, but remember, we're just a tweet, post or a call away. So keep your queries coming and we promise to address all of them through our shows.